My other investment recently has been I've got a 900-acre farm up in the mountains of Puerto Rico, and so farmland never went into a bubble, and people always need to eat, and so that is another very resilient investment that I'm making. But you're talking about precious metals as though it's only a safe haven, it's only insurance. And there are these brief moments in history where the safe haven investment, the insurance for the last 2,500 years, simultaneously becomes the asset with the single potential gains in absolute purchasing power. I'm looking for some pretty spectacular prices, and then you've got things like mainstream banks, Morgan Stanley, recommending to go from a 60-40 portfolio, 60% stocks, 40% bonds, to 60% stocks, 20% bonds, and 20% gold. So they're saying sell half of your bond holdings and convert them to gold. This is just like a whole new world. This, to me, signals the beginning of the third and final phase of a bull market, and that is where you have the greatest amount of gains in the shortest period of time. So we should be seeing some fireworks coming.
Well, and let's talk a little bit more about where you see this gold bull market going in terms of prices and developments along the way. I don't think I've ever heard anyone mention just the sheer number of more people that there are now versus back then.
Yeah, well, like I said, it was for the first half of that bull market, it was just Western Europe. Canada was a very small population, but they did participate. But the U.S. didn't join the party until the first day of 1975. And it's interesting, Roosevelt had made gold ownership illegal back in 1933, and but I believe it was 73% of the gold coins in circulation were not turned in. They remained illegally in private hands. And so when gold became legal to own in the United States, first day of 1975, it had gone from $35 to just under $200 an ounce by the end of 74. First day of 1975, it started to fall. And I believe that's all these people that were sitting on the coins that were passed down from their father, their grandfather, whatever, and they had been sitting on them for 50 years, not able to sell them because they were illegal. And so all these Ellis came out of from hiding, and at the same time, there was a bear market in stocks that ended, and stocks started recovering. And so gold went from just under $200 an ounce down to $103. It lost almost 50% over the next, I believe it was 18 months or so. It was toward the end of 76 that it bottomed at 103, but then it turned around, and the intraday high was actually $873, not the $850. $850 is the close. The intraday, though, $873. Coincidentally, the Dow Jones Industrial Average was at 873 points at the same moment. So it was a 1-to-1 ratio, Dow Gold.
Consider the modern world. Billions more people, far more participants in global markets than in past gold runs. The 1970s rally began in Western Europe and Canada. The US only joined in 1975. Back then, gold had been illegal for private ownership in America since 1933, and re-legalization unleashed dormant demand. As gold surged from $35 to nearly $200, hidden hoards emerged. Today, with massive population and investment capacity, the base is far larger. This expands the potential upside, and when the tide rises, the boat lifts higher. The next gold phase taps this global expansion of capital and participants.
This is a very difficult thing because I do believe that there is a giant crisis heading towards us. If you look at like the 1929, that was a stock market bubble only. Real estate was not in a bubble. Gold was fixed. It was $20.67 an ounce. And then you go to 1966, stocks were in a bubble, and they corrected from 66 to 1982. the Dow Jones bumped its head on 1,000 points and couldn't break through from 66 to 82. And during that time, we had raging inflation. Company profits went up, the number of dollars that they were in. So all the price-earnings ratio, the PE, all the ways that you can measure whether a stock market is in a bubble or not, it corrected, and stocks became severely undervalued by 1982. Then we went into the tech bubble in 1999-2000, and stocks were extremely overvalued, and then crashed, and we ended up with, each one of these crashes and corrections. I don't know, there's not that many people that recall the 1970s, but the raging inflation we had, and then the double dip recession that we had at the beginning of the Reagan era, there were some pretty tough times. Even though we didn't have a major stock market crash, we had this slow grinding correction. With the NASDAQ bubble, we had a major stock market crash that ended up in a recession, but real estate was not overvalued. Then we get to the global financial crisis. Stocks were not overvalued. They were back down in the fair value region because of the NASDAQ crash, and it was real estate that was in a bubble. Today, we have historic bubbles in real estate, stocks, and bonds. And I mean, the only way that you can measure stocks that doesn't show them in the largest bubble in history, it shows them in the second largest, is PE ratios. But every other indicator shows stocks being more overvalued than at any point in history. And then when you look at commercial real estate and residential, same thing. It's the more overvalued than we were in 2007. And so it's going to be a crash of all of these asset classes against gold and silver. One thing about bubbles is they can't go forever. When the economy starts out balanced and you've got one sector of the economy growing so much faster than the whole rest of the economy, and your audience can feel that a couple of years ago, the stock market, the markets in general sort of detached from the real economy. The real economy is not doing that well. But stock markets, real estate, stuff seems like it's gone insane. And then the national debt, and it isn't just the U.S., it's all over the planet where countries are spending their way into oblivion.
We are not dealing with a single overheated market. We face bubbles across stocks, real estate, and bonds simultaneously. Historically, one sector balloons while others remain stable. In the 2000s, real estate inflated wildly. In the 1990s, tech soared. Now, valuations across asset classes are extreme. Commercial real estate is arguably more overvalued than in 2007. Consumer debt, sovereign deficits, and trade barriers add pressure. Tariffs slow trade. Weak labor market growth undermines confidence. In that environment, assets backed by nothing tangible become volatile. Gold and silver, with their intrinsic value, start to appear less niche and more necessity.
I think the tariffs that have been imposed are perturbing the world economy enough. It's just taking a little while for it to happen. Right now, everybody is betting on the AI bubble, that is going to be so huge that there's nothing to worry about. I just think there's going to be this giant correction, but tariffs and world trade. When you install tariffs, you slow down world trade, and I think that will be the thing that ends up popping this. We'll have some other event that sort of coincides with all of this, and you never know what is going to come. When the NASDAQ crashed, Alan Greenspan tried to reflate the stock markets. He didn't see the real estate bubble he was creating over here out of the periphery of his vision. But that whole global financial crisis, that was caused by Alan Greenspan's reaction to that, and then all of these new things like mortgage-backed securities and collateralized debt obligations and so on. But He didn't see that coming at all. He created that bubble, and he didn't see it. And so you never know what's going to come at you out of left field.
Precious metals usually serve as insurance, an asset you buy in case things go wrong. But rare moments crop up when insurance becomes the offensive play. We may be at one such moment. Gold and silver not only protect, they offer outsized purchasing power gains. One investor explains he holds 300 ounces of silver for every ounce of gold, anticipating a gold-silver ratio swing from 85.1 down toward the historic average of 13 to 16.1. In other words, when silver catches up, those holding it benefit dramatically. This shift transforms metals from backup planning to core strategy and wealth preservation.
My other investment recently has been, I've got a 900-acre farm up in the mountains of Puerto Rico, and so farmland never went into a bubble, and people always need to eat, and so that is another very resilient investment that I'm making. But you know, you're talking about precious metals as though it's only a safe haven, it's only insurance. And there are these brief moments in history where the safe haven investment, the insurance for the last 2,500 years, simultaneously becomes the asset with the single potential gains in absolute purchasing power. We're in one of these rare moments in history right now, and we've seen tremendous gains in the purchasing power of gold and silver. It isn't just protecting your portfolio. You know, it's still sort of considered by most people some lunatic fringe investment. I've been investing in gold since my first purchase was in 2002, and the spot price was $315, and I was buying gold eagles at $325 each, and I've been buying ever since. I was a precious metals investor before I was a precious metals dealer and author and commentator. And so I'm basically practicing what I preach. But the gains have been absolutely spectacular, and they're not done. They are nowhere near done. The Dow gold ratio tells us that, the gold silver ratio tells us that, and all of the reckless government spending all over the world tells us that.
Charts reveal a parabolic structure in gold's rise, a steep climb, a brief correction, and then the potential for rapid acceleration. These patterns often precede explosive gains, but also sharper corrections. Take Bitcoin. Its chart shows a megaphone pattern, higher highs, lower lows, a dangerous technical shape signaling rising risk. Gold's pattern is different, but when markets move fast, exits can be sudden. For investors in metals, timing and conviction matter. This isn't about casual speculation. It's about recognizing that the chart's next phase may move swiftly, and volatility may come from both directions.
No, I'm a believer in waves and cycles. I intend on selling tranches. The first thing is I try to not make my investment decisions based on emotions. And so I use the gold-silver ratio to tell me whether or not to buy gold or silver. And because the gold-silver ratio has been so out of whack, I own 300 ounces of silver for every ounce of gold. It will come back into balance one day. We don't know when. It's going to take a little while. But I believe you're going to see the gold-silver ratio in the 20s or less. In other words, right now it takes 85 ounces of silver to equal the value of 1 ounce of gold. If it takes 80 and you buy silver and it goes down to 20 and you sell your silver and buy gold with it, you just got 4 times more gold than you paid for. And so it's a strategy that can be back tested. It works. And for 2,500 years, the average exchange rate was about 13 to 16, somewhere in that range, ounces of silver to 1 ounce of gold. So this is something that has only existed since the big discoveries of the Comstock Lode and the Silver Valley in Coeur d'Alene, Idaho, back in the late 1800s, and simultaneously governments around the world went on the classical gold standard, and treasuries dishoarded their stockpiles of silver. And so all this silver flooded onto the market, and silver's value plummeted compared to gold's value. And it has bounced up and down, but we've been at these historic high areas of like 100 to 1, and during COVID, 120 to 1, which had never happened. In 2,500 years of gold and silver being money, that had never happened. And so this was something that was a great opportunity. And by allowing the gold-silver ratio to sort of dictate to me which one I'm going to buy, I ended up buying a bunch of silver during COVID, right around $11 an ounce. And so that was pretty nice.
Pretty nice.
Right. But like I say, it's nowhere near done. When you look at how the bull market of the 70s progressed, and then you look at this natural balance that different sectors of the economy, stocks, bonds, real estate, precious metals, energy, and when you do these, they're called ratio charts, where you divide one thing by the other. What you're doing is you're eliminating the national fiat currency from the equation. And the national fiat currency creates this smokescreen, this fog that we can't see through. You can't see what true value is. So, you can get an idea of this. There's a couple of online chapters from my last book at ggsr21.com. And chapter 3 is the shortest and most entertaining chapter, and it's going to benefit you for the rest of it. It's just a primer on how to read charts and how to see when whoever created that chart is trying to lie to you, how they're trying to influence your perception. And but it shows you that the way things are priced in national fiat currencies, it's very difficult to perceive what true value is. And so, anyway.
The larger backdrop is a monetary system under stress. Massive debt, near-zero interest rates, speculative excess, and global policy missteps create a landscape ripe for change. Gold's rise may reflect not just demand, but an upcoming structural reset. Whether triggered by banking stress, tech implosion, or currency crisis, the result could be a realignment of wealth and capital. Holding gold in that scenario isn't just cautious, it may be visionary. The question isn't if capital will seek safety, it's when and how fast. And for many, preparation is not optional.